Hello everyone and a very good morning to all of you. Distinguished delegates, presenters and participants from SAARC member states and region around the world. It gives me a great pleasure to extend you all a very warm welcome. Ladies and gentlemen, I on behalf of Director SAARC Energy Center thankful to all of you for joining us in this video conference to disseminate study on challenges in financing of utility-scale clean energy projects in SAARC countries. I am Ehsanullah Marwat and I am working at the SAARC Energy Center as Research Fellow Energy Efficiency. I shall be moderating today's video conference on behalf of Mr. Tanveer Ahmed, Program Leader Technology Transfer. Ladies and gentlemen, you will have the opportunity to ask questions to presenters by typing your questions or clicking to the raised hand option in the attendees pane of the main window of GoToWebinar software. You may send in your questions at any time during the presentations. We will collect these and address them during the question and answer session at the end of each presentation. Additionally, you will also have a chance to share your views in knowledge sharing session of the video conference. Ladies and gentlemen, let's move to our technical session and start with formal presentation. We have Mr. Sandeep Kumar Mohante from PricewaterhouseCoopers Private Limited, India, who are the authors of this study report. Mr. Sandeep Kumar Mohante is Director Energy and Power with PwC India. He has 11 years of professional experience in management consulting. He has supported several state and central government entities, investors, global utilities, and private equity clients on financing strategy, market research, financial modeling, commercial and technical due diligence, and strategic advice on growth, market entry and expansion. Sandeep has expertise across various sectors such as power utilities, mining, urban transport and agriculture. He has worked on multiple engagement across India, Nigeria, Vietnam, Saudi Arabia, SAARC countries and ASEAN countries. He has been supporting various funds in carving opportunities in the SAARC region and setting up operations in respective countries. He holds a master's degree in business management, specializing in finance and strategy. So over to you, Sandeep, sir.
Thank you very much for the kind introduction, and a very good morning to all the attendees. So today's presentation, we did a study a couple of months back around challenges in financing utility scale clean energy projects. Clean energy particularly has been quite a bit of focus area in our overall power value chain, and this is not just true for specific countries, but I think globally as a whole, we are targeting. In fact, most countries are looking forward to moving towards clean energy, not just as a sustainable source of energy, but also because technology has driven the cost of clean energy lower, which makes it really attractive for price-sensitive consumers as well. So that's been the focus of our presentation, and the way that we have structured the presentation. If we look at the contents of the presentation today, next slide. The way that we have structured the presentation is give a brief idea about how clean energy has grown in the SAARC countries. What are the investment requirements? What are the plans? And given the demand growth that SAARC countries are expected to witness, what is the role that renewables is expected to play? So that's first bit of our presentation, where we essentially lay the groundwork of indicating that what could be the potential investments that we could see in the region. Post that, we'll talk about what are the big challenges in terms of financing. It's important to understand because financing is one of the key resources within renewables. In fact, one of the most important resource. And if you're able to address these financing challenges, renewable can actually grow substantially, and we've seen that in experiences across the world. And post that, we also have looked at that in each individual country, how do the countries fare within those challenges. Again, in some of these cases, it's very contextual. For example, if there is a country where the investments are being undertaken by public utilities, the challenges could be different compared to countries where predominantly the investments are catered by private sector. So that has been, our basis for analysis of what are the gaps within each individual countries, and then we end up with specific set of recommendations, which is contextualized for the South nations. So that's the brief, flow of our presentation today, and we hope to look forward to a very vibrant session post our presentation as well. So very quickly, I think the SEC or SAC Energy Center primarily commissioned the study to understand what is the current investment environment in clean energy technologies. That's one. Discover the challenges in financing clean energy projects, and understand the required programs to mobilize funding of utility scale projects in SAARC member countries. So that's broadly the three objectives of the study. So SEC, as we know, is a multilateral initiative to push energy sector growth within the SAARC member nations. And over the years, it has conducted various knowledge sharing sessions, including a whole lot of focus around clean energy. And this study essentially is synonymous to one of the big activities that SEC has been undertaking around knowledge transfer. So we'll very quickly, so that's the objective of the study, and we will very quickly move to the next slide. Yeah. So one of the big things that we have seen, that despite most of the countries within SAARC having huge potential, and also I would say intention of the policymakers to increase reliance on clean energy technologies, the growth in implementation of utility scale projects is still not as much matured as in most SAARC countries as probably elsewhere around the world, and because of various reasons. Among the key, I would say, challenges has been that the uh, the the cost of acquiring technology has been quite high, and most of these clean energy projects that we see are driven by largely its technology cost. There has also been, a slow development of skill set because that transition takes time, and building up capabilities where people are trained in terms of planning and executing renewable projects also has been comparatively slower. And one of the major reasons of slow growth for utility scale projects in the SAARC compared to countries, European or US or even China, where we have seen this growth, substantial growth compared to the SAARC region. One of the primary hindrance has been availability of affordable, low cost, long term funding. Because I mean, if you just simply look at the cost of capital for SAARC countries vis-a-vis cost of capital of any of these countries that we talked about, there has been a substantial gap, and I think that those are the challenges which we intend to address in our presentation today. In the last 3 years, SAARC countries have collectively attracted about 4% of the total investments worldwide that have gone into clean energy sector. Of this, obviously, because of the size, India has attracted about 84% of the total investment within the SAARC region between the period 2013 to 2018. This is followed by Bangladesh, Pakistan, and then Sri Lanka. while the rest of the member countries have seen just marginal investments, but also primarily because their total base of energy generation is comparatively lower. Next slide, please. Yeah. So this is primarily to show that how capacity additions have happened in the past 5 years, from 2015 to 19 period. And we have specifically looked at solar, wind, hydro, and bioenergy, all of these individually. Of course, looking at the SAARC member nations, what we could see that in terms of growth as a pure percentage number, Maldives has been the highest, but also, this which is about 20% growth year on year in this 5 years. But that's also because the total base of installed capacity is comparatively lower in Maldives. The total clean energy installation has been about 14 megawatt as on FY19 for Maldives. Post Maldives, I think other than Maldives, the second fastest growth has been witnessed in India, which is roughly at about a little over 10% year on year for the last 5 years, and this has been predominantly driven by large government auctions, which has happened within India. The total growth rate, in fact, what we've seen is about more than 40% between the period of 15 to 19 in India, where the capacity has gone from 5.6 gigawatt to about 35 gigawatt in 2019. And this is predominantly in solar. The next country where we have seen again substantial increase in renewable capacity has been Sri Lanka, where the growth in solar has been about 47% between that period, and bioenergy roughly about 16% within this period. And these two has been predominantly the large growth areas for Sri Lanka. So I mean, while we can really see that there has been some big numbers as far as countries are concerned, specifically in India, Maldives, to an extent even Nepal, Pakistan, we've seen some big numbers in terms of growth. But uh, what is very important to understand is that these growth rates are still substantially lower when we look at equivalent period growth rates of some of the more dominant economies, including likes of, for example, China, in Middle East, in Europe, or in US. So many of these countries, the growth rates have been substantially lower, and also in terms of the megawatt installation, it has been really phenomenal. So it's important for us to replicate some of those success stories, and part of it actually goes back to the fact that can we get capital availability? Can it be made easier? Can we have low cost, long-term patient capital be made available, and what are the measures which we can undertake? So this is about the overall historical growth story for renewables within the region. Next slide, please. In this, we just wanted to very briefly, I won't spend too much time on this, and I think the SAARC member countries, what we have seen by policymakers, at least in the statements that have been made, while achievement probably has been comparatively lower than what we would have anticipated, but I think there is a fair bit of understanding of the benefits of clean energy technology. I mean, simply from a perspective of both ESG, it actually has an impact on environment in a positive way in terms of lower pollution, lesser carbon emission, and also now a lot of initiatives have been undertaken in water conservation as well. It has definitely a social impact because essentially you are replacing conventional fuel, which leads to better health for the local community who are involved, as well as it generates employment for the local community because typically once the renewable capacities are set up, the skills that are required to operate these facilities, a large part of it is actually unskilled, which is basic. For example, in solar, you require a huge number of people to be as security guards or to actually do daily cleaning activities, which are fairly low skilled. And what we have seen is that largely developers tend to rely on local communities, so it actually leads to leads to creation of jobs, which is one of the big benefits for the renewable energy implementation. And of course, then there are the economic benefits pertaining to investments happening. And a lot of these investments, if we have the right conducive environment, can happen from global, from global companies, which means that there is more FDI which is happening into the country, which is always positive for the region. Specifically, I want to talk about job and employment generation, because this is, I think, one of the aspects which is not quite talked about. But really, if we see that there is a substantial quantum of jobs which can get created because of renewable energy, and as I said, a large portion of this job actually is lower skill jobs. So which means that there is you have the ability to engage with the marginal society, with people below poverty line, and actually generate employment, because these are located generally in quite standard locations outside cities and all. And it's actually, from an economic perspective and job creation perspective, a fantastic initiative. So that's we just wanted to very quickly touch upon the benefits of the renewable energy projects as well. Let's move on. Yeah, I think we just wanted to point out, have a very because each country, while in some cases, in some kind of projects, there is a very clear definition of what a utility scale project is. But we thought that it made sense because there were some variations in terms of how do we classify, or what do we classify as a utility scale projects across different technologies. So for the purpose and benefit for the audience to look at, we just try to map what makes up a utility scale project across different technologies and across different countries, just to give a very brief understanding of what sort of capacities and we are talking about specifically to individual countries. So, for example, in Afghanistan, anything which is above 10 megawatt is termed as utility scale projects, whereas in Bhutan, which is predominantly a hydro-dominated country, anything above 500 megawatt is considered to be large utility scale projects. So the definition can vary depending on countries' own requirement, their own resource, etc. But essentially, when we are defining utility scale, these are fairly large projects which are connected to the grid, and which can actually give a lot of economic scales of economy in terms of pricing. So I won't spend again much time on this, but we could very quickly move on to the next slide, because this is what we have used in terms of estimating what is the project pipeline for individual countries, and these are some of the numbers that we have arrived at. We looked at each country and the policy statements within each country very specifically to define what kind of investments or what kind of pipeline we expect to see in the next 10 years. And I will just, but of course, this is slightly more skewed towards larger countries like India or Bangladesh or Nepal or Pakistan, because predominantly these are more populated, and hence the energy requirements are substantially lower compared to probably a Bhutan or a Maldives. So, but just generally giving you a total capacity addition requirements, and we are talking about really, really big numbers. I mean, even for Afghanistan, we are talking about a 5.5 gigawatt capacity, which means that it would really require more than $7-8 billion of investments. Similarly, in Bhutan, we're talking about 7.6 gigawatt, which is predominantly hydro capacity addition, which means that this is over $10 billion of investments. In India, we're talking about 300 gigawatt additions. So these are Pakistan, about 48 gigawatts. These are very, very big numbers we're talking about. And this would require billions and billions of dollars of investments. And these are the investments which while government obviously can provide from its budget, but again, if I'm providing budget for capacity or generation capacity addition, which can actually attract global investors, then we're actually taking capital away from maybe other socio-economic sectors. So this is one of the areas where we believe that the role of government can be more in terms of being an enabler, while you can actually have private capital investors who can come and invest in this, because there is an interest globally, a huge amount of interest globally to invest in clean energy. Just to give you a sense of number, in by this year alone, the number of institutional investors who have committed towards responsible investment stands at about $105 trillion. So that's the amount of capital which is available to be invested in clean projects. So I mean, clean, of course, across the value chain, but within that, clean energy is a big chunk of sustainable investments in the world. So there is huge capital available. There's a huge demand in the SAARC countries. Now the question is that can we create a pathway between the huge supply available and the huge demand, and that's the primary objective of our presentation today. Let's move on. I'll just ask for 1 second. I'd like to have some water. Yeah, thank you. Sorry. So essentially, so that's the overall investment requirements. So what we have done is we have translated the total capacity addition into investment requirements using certain benchmark number. And as I said, you could really see that these numbers are substantial in terms of total quantum. And we have a supply, we have a demand. The challenge is how do we create a seamless pipeline between both. So we can quickly move on to the next one. Yeah. So what are the key drivers for new investments? And obviously, um, there are big pushes coming from the United Nations, or from the global community, if one can say. So most of our countries are subscribed to the UN Sustainable Development Goals (SDG), and there's a COP21 review which is also scheduled this year. So the idea is that many of the countries have taken up voluntary carbon reduction targets, which, and predominantly this is achieved by increasing renewable energy capacities and energy efficiency as well. So that becomes one of the big drivers, because all countries and governments are essentially are interested not just to do good, but also to look good in front of global community. And this definitely is one of the big drivers. It gives you energy security, renewable energy, because you don't have to rely on fuel. So many of the SAARC countries, in fact, specifically from oil and gas perspective, do imports, and the plants are run basically on imported fuel, including some of the coal plants which are run on imported fuel. But this ensures, renewable energy, because you don't essentially require fuel from other places, and these are very robust and fungible assets. So this provides you the level of energy security that is required for your country and for the system. It certainly has some cost advantage. For example, we have seen the price of solar today almost is at 50% to the price of conventional capacity. The price of wind would be roughly at about 70% of the price of conventional energy. Again, hydro capacities, because these are more or less like perpetual assets, you tend to have very, very low cost after 15 years once the debt is out. So there is really some cost benefit which benefits for the entire society and for to everybody. And I think that is also one of the predominant drivers. And of course, the fourth one is that investors. There is a huge, as I was describing, there is a huge set of $105 trillion of responsible investors who want to invest in this sector, because the people who have committed capital into it do not just want growth, they actually want sustainable growth. So they are keen to invest in renewable energy companies. And these are predominantly the reasons why we see that the utility scale projects is all set to grow, provided we have the right environment for them. And from the next slide onwards, that's what we are going to talk about. I think next slide. Yeah. So what are the so basically in this slide we're going to talk about what are the big challenges, and we have tried to bucket it into certain buckets, and I think there are about 6 buckets, 3 on this and 3 on the subsequent slide. So the first bucket that we're talking about is in terms of sovereign risk, because we need to understand that energy is essentially a subject where there's a lot of involvement from the countries and from policymakers, which means that if you're having if you're putting up a generation capacity, effectively the government of the country is guaranteeing sort of the payment. I mean, it can be in form of direct guarantees to the PPA. Like for example, in India, there is a public utility like SECI who actually does the procurement. So it's in sort of providing guarantee in a very different structural manner, or it can also be in form of indirect or direct guarantees, where actually the government ensures that the payment actually happens to generators. So in this case, the sovereign risk is very important, and let me explain to you why it is important. Because so what will happen is that if let's say if I'm an investor who is based out of let's say ABC country, and I have two options to invest in US, which has a AAA rated, which is basically AAA rated sovereign, and I have another country within the SAARC, which could be, let's say, triple B rated. Now, even if assuming that I consider both countries exactly similar, and I don't see any risk perception, I don't have any personally don't have any risk perception which is different, while there is. But if let's say as an investor I'm comfortable with the SAARC country and with US both in equal manner. But the moment I actually go to raise 70-80% of debt, which is substantial quantum of my total investment, uh, if I'm raising debt for a project which is based on US, it will be rated much higher than if I'm going to raise debt for one of the countries within SAARC. So that is just because both have a very very different credit risk. So essentially, you could easily see a spread of anywhere between 2 to 3%, depending on what the credit rating is, in terms of the difference between the cost of fund requirements between the two countries. So and then that's substantial in terms of credit rating. Although I would really say that the sovereign risk, while in certain countries, is still continues to remain higher because of certain uncontrollable factors as well. But in many of the other countries within South Asia, the sovereign risk, while the rating from a rating perspective, it may not have changed over the years, but the perception of investors has certainly changed. So now when the investors start looking at maybe, let's say, a country like Sri Lanka, they are more or less comfortable in taking equity risk in Sri Lanka. So to that extent, I would say the sovereign risk, while this is still a big criteria for some countries within SAARC, while for some of the other more market-oriented economies where the markets have been functioning for a very long period, investors have some level of comfort as far as sovereign risk is concerned. So I won't go into the details of how to measure it, but just leave it at there. The the second bucket of risk that we often see financial investors talking about is institutional uncertainties. Now, one of the things which anybody who is investing capital, and effectively we are talking about clean energy projects which have PPA or contract duration of 20 years to 40 years to 50 years in case of hydro as well. I mean, that's the typical license period you might have. What we have essentially seen is that investors want a certainty. I mean, it is fine that if they are, instead of earning 12%, they can earn 11%, but they should have a comfort of earning 11% throughout the duration. And the biggest challenge that many of the global investors have, it's specific to emerging regions such as SAARC, is that there is less certainty of regulations in many countries. And I mean, it's not just specific to SAARC, but many emerging countries have this challenge. So, for example, every time a new regulator comes in, he will tweak the regulation in a way that it changes uh, the, the dynamics of the contract that has been entered. So, it is essential that once we put up that once we have a regulatory regime, or once we have an institutional regime, that institutional regime stays consistent for a longer period of time. It gives, it is a, I mean, this is not spoken out about so much, but this is immensely important for global investors. Certainty of getting back their capital. It might be lower return, which is still people would be attracted, provided that the risk is not there, the variability is not there. Lower return is still fine, but variability of return is not fine. So institutional uncertainty is something which is certainly one of the big hurdles that countries would look to address. In fact, we just gave an example of Nepal, where there have been huge, large hydro projects which have been approved since 2000, but for various reasons, there has been substantial delay in terms of execution. So. And this is not just for Nepal. In every country, we have seen that the challenges in getting clearances, approvals, these keeps on changing. We have suddenly new governments coming up who try to open up the PPAs again, open up the contracts, and try to renegotiate it. These are not something which is welcomed by global investors. They don't want this. They want complete certainty for the duration of the contract, and that's one of the most important aspects for them. The third aspect is volatile foreign exchange market. Now, uh, this is a little tricky subject for many of the SAARC countries, because for many countries, we don't have a freely tradable currency. Now, for countries which have a freely tradable currency, where there are you know market-based hedging products available. For example, you get hedging products for India to a very large extent. So for these for countries where there is a large hedging market, and there is the currency is more or less free tradable. There is a history of numbers of forex variation that investor can see. This what we call as a what we call as a forex price curve. So that would actually, or a forward premium. So basically, that will actually give investors certainty, that because their home currency might be in dollars, and when they're investing in India, they're getting money back in, let's say, rupee, and they need to ensure that the investors in their fund, or whomever, their shareholders, basically get the return in terms of dollars. So to that extent, there are different. This is a big concern, and I think um, more important than the concern of variation, I think the concern with many of the SAARC countries has been getting dollar capital out, because effectively many of the smaller countries like Nepal, for example, even the larger ones like Bangladesh, the amount or the way in which forex can be invested and taken out, there is certain amount of regulation around that by central bank, and for very good reasons, because they need economy to be stabilized. But for institutional investors, this is definitely a hurdle, because they want to invest and take out money, especially take out money more freely, because investments can happen with approval, but they need to certainly take out their own money in their own currency a little more freely. So this is definitely a hurdle, probably at a much more larger a socio-economic level. Central banks are involved in this, but there has been a lot of effort to allay these issues as well. For example, I'm aware that Nepal has been very actively pursuing, forming a currency exchange fund, which is or hedging fund, which could be which will be monitored by NRB, and there have been discussions in several policy papers around this. Something like this can be immensely helpful in attracting institutional investors into the country. So this is, I think, the third bucket of challenges, which is quite important. Let's move on. The fourth actually draws from the sovereign risk criteria as well. This is that many of the utilities that we have within the SAARC nations, and when I say utilities, these are predominantly, let's say, distribution utilities, who are essentially the buyer of renewable power. Their financial health is not good. Most of them make continuous losses. They rely on government for continuous functioning. Their operational track record, while might have been fine, but financial track record definitely is not something which is encouraging. And in many of the cases, we've also seen payment delays happening to basically generating companies, and these all the credit risk, and this basically adds on to the credit risk of the clean energy project. And this is certainly one of the big concerns where. And I think the prime example that we could see is in India, where you have uh, projects or opportunities which are floated by central government or state governments who have very good financial health, like Gujarat, for example. And then you have opportunities which are floated by certain states which are not so doing well. And we do see a clear difference in terms of participation. We see heavy participation in case where there is a central government tender, and we see very less when there are state governments with bad financial rating. So certainly this is one of the it's probably easier said than done, but this is one of the areas where we need to ensure that the distribution companies who are buying power do pay the money and do pay the money on times, and this is very, very, very important. So that's, I think, the fourth bucket of challenge that we have. The fifth bucket is around scale of project. And this is slightly tricky issue, because what we have seen is um, that if you have very large projects which are coming up, where investors can deploy capital very quickly and deploy large amounts of capital very quickly, provided the other risks are addressed, this tends to attract large low cost investors quite more, because the amount of time and the amount of expenditure they have in form of transaction cost is lower when you have large project vis-a-vis very small projects, where you tend to spend a lot of in terms of customer acquisition, in terms of transaction cost. So generally, and this is in no way of saying that rooftop projects or distributed renewables are not of interest. They are of interest, but the way that these market function is that there would be a primary domestic developer who will set up the distributed renewable projects, and then there would be the institutional guy who comes in after there is scale to invest into the company or to buy out the entire scalable projects from the domestic developer. So that's how these markets. So it's important that we ensure scale to happen. Now this is so in, I would say, in solar, in wind, and also probably in hydro, we are seeing certain levels of scale which are being achieved. I think bioenergy is one of those areas where I believe that what we have done is that we have invested in certain pilot projects, or we created certain pilot projects, but we really did not scale those up. And when we tend not to scale those up, then that actually is not a very big interest. While from a project attractiveness point of view, it might be still continue to be attractive. It might be attractive for certain investors, but it doesn't attract investments if you're unable to scale up the opportunity in a particular segment, and that's very, very crucial. And I think the sixth challenge, which is again a slightly overarching challenge, is that the long-term financing market um, is that the long-term financing market has been extremely badly organized in many of the SAARC countries, and it's not to put a blame on anybody, but there are of course reasons why these are not organized well. But yeah, so I think that's the finance. And see, in a typical in a typical functioning economy which has large amounts of infrastructure investments happening, so you have essentially three types of financial markets which are relevant, or financial groups which are relevant. One is the predominantly the banks who come and invest in greenfield projects, and they would generally have a very quick exit time. So would have an exit time of 3 to 5 years. So they would be happy to price in the construction period risk and give you capital upfront. You invest, but once the project is construction up and running, then the segment of banks generally tend to move out, and you need to have a well-functioning capital market where actually these investors can go and refinance their debt. So the banks get an exit, and the interest rates are locked in for a very long period for the investors. So that's the third bit, and the fourth bit is of course the area of private capital or private debt capital, which essentially means that there will be certain projects which banks will not be able to finance because of their risk thresholds. And that's where the private, for example, there could be corporate PPAs, which a bank may not be comfortable in financing. Bank may be more comfortable in financing utility scale projects. So those are the segment where you could have the private capital investors coming in, and they price the risk accordingly. So uh, for a well-functioning infrastructure market, it needs to have all these three buckets of matured, financial groups functioning together and in harmony. And in many of the countries, when SAARC, we'll often, I mean, capital markets certainly is one of the big groups that needs development. Even on the private credit market, we have not seen much of formal activities. It's happening now in certain countries like India, but we've not seen growth of private debt to that extent as expected in many of these countries. So this, I would say, essentially is the six big challenges that we have within SAARC. Let's move. Yeah, so essentially what we've tried to do is map these financial risks, these six buckets of financial risk across the SAARC countries. And what we very clearly see is that there are certain countries which obviously have high risk across all parameters, and well, this is partly due to due to factors which may not be relatable to government policies or may not be relatable to the country itself. There could be a lot more external factors which are impacting not non-performance in those specific areas. But there are certain, of course, certain of these drivers which can certainly be addressed by countries if they start looking at it within each of them. Wherever, for example, I'm rated high risk, how can I ensure that I help in the market development? And I think one of the most predominant ones that we are seeing is lack of long-term, financial market, specifically the debt capital market being available in SAARC regions. And this is one of the avenues which can certainly be the first areas where we could target interventions. The second, of course, the big challenge we are seeing is lack of equity finance. Again, lack of equity finance, one of the areas where we can very quickly target by building right tax policies, by building right policies, ease of entry and exits. So, I mean, equity markets essentially can function very well if we have a good exit market, if we have lower entry barriers, if we have right taxation policies, and if we have a very transparent form of investing and repatriating investments within the country, because these are effectively coming from international locations. So these are some of the risk mapping that we want to show. I won't spend too much time. This is there as a part of the report, and Obviously, many of the solutions we are suggesting is dependent on how each of these countries fare for risks all across. Let's move. Yeah. So this is what we try to build is that look, there is obviously challenges which is there for all the countries, but what would an ideal market look like? And that's what I have been discussing with. So an ideal market would effectively have three things. One is that it would have a very vibrant OTC market, and when I say OTC market, these are essentially non-exchange traded products, which means that when you're going to take long-term loan from banks, or you're going to take a private equity, which is bilaterally negotiated, these are all part of OTC products. And within OTC, you need to have instruments of all nature. So you need to have debt instruments, you need to have equity instruments, and in certain cases, very useful, you need to have hybrid instruments as well, because that actually can lead to a better effective utilization of tax norms in many countries as well. So though that's the type of capital available, you need to have also very flexibility in terms of instruments which are available, and most important thing, you need to have institutions which are functioning in each of these markets. And this is what I was really talking about. In debt market, you need to have commercial banks. You also need to have private investors who are functioning vibrantly within the debt market. Similarly, you need to have private equities and infra funds and mutual funds who are all operating within equity domain and hybrid equity domain. So we need all sides of institution, and among all, because the other things will come automatically. Among this, formation of institutions is the most important thing that we need to address. So that's the OTC. The second, which I think a lot of work has been done around this, is around capital markets. We need to have a very vibrant both debt and equity capital market, especially for infrastructure projects, because they are very, very important for infrastructure project. And as I was describing the life cycle of a project with you, the way that it typically happens is that you get initial funding from banks or private capital, and then once the project is commissioned, you use the capital markets to flip over investments. So that's extremely useful, and this is the mechanism through which most infrastructure projects get financed across the globe. But unfortunately, in South nations, the debt, while equity capital markets have been functioning well in many geographies, I think the debt capital market is certainly one of the areas where a lot of work needs to be done, and a lot of interventions are required to make it more vibrant. The third bucket, and this is basically, while we are calling it as grant, but it's effectively the public money market. So the reason what we are saying why we put a public money market is that is about that there is also, along with private and the institutional capital which comes into a sector, there is also public money which goes into the sector. And quite often this money goes in either in form of grant, or they will go to a public sector enterprise in form of equity, and then the public sector enterprise would develop the project. But it's also important that we really it's also very important that we really know that how best a public money can be used, and we will talk a little bit about it in the later slides. But a public money, instead of being directly utilized for setting up project, it has a great potential to play the role of an enabler, which means that right now, if you're investing in form of a grant or equity for 1 megawatt of project, you may put up, let's say, $1 million of grant or equity. But if we use $1 million in form of financial guarantees, or in form of providing certain exchange related incentives, that can actually translate into a into multiplier effect in terms of capital coming into the country. So there is really benefit in terms of how, I mean, this should be one of the big focus areas, and I think it is in many cases, is that how public money is used, and is it best used in form of directly putting in as grant, or maybe giving in other forms of financial guarantees, etc. So that's very crucial for us. Let's move on. I think we are really very short of time now. I'll try to rush through the other presentation. So these are, so this is basically a mapping of what the investor expectations are, and it is important to understand these investor expectations well, because that will help us form the right policies at government, help us put up the right institutions which are required in the country. For example, a commercial bank would have and this would again depend on what are the policy rates in a country, but typically the cost of borrowing in SAC can be between 7 to 10% for a normal project. If it's a private debt, or if it is NBFC, which relies on purely bond raise or money market instruments for funding, the range can be slightly higher. So we've seen between 8 to 11%, about 100 basis point difference. The horizon for commercial banks in the SAARC countries typically is between 5 to 15 years. And it can, in some cases, be even longer than that. But this is, I think, one of the, I think it's slightly different globally. Globally, they typically have a shorter duration, about 5 to 7 years, rather than 15 years or 20-year period. And this is predominantly because they have a well-developed capital market. So after 5 years, once the project is commissioned, most investors actually flip up the assets into the debt capital market, and they would refinance the debt. And actually, the commercial banks, if you see the deposit, the deposit is basically, the average maturity of deposit can be 3 years or less than that. So it makes sense to have a lower threshold on that. And of course, but if you look at from an equity perspective, the return expectations are typically higher. While it's not available, I can give you an indication that in case of clean energy within SAARC region, it can be in the range of about 15 to 20%, depending from country to country, and that's where the sovereign risk comes into play. And their investment horizon can also be very different. For example, if it's a private equity, investment horizon is 3 to 5 years. It can go up to 7 years for exit. If it's an infrastructure or a pension fund, they are generally locked in for even a longer period of 10 years, 15 years. They're not very, they don't have a very affinity of selling the asset, whereas private equities have. So that's the kind of difference that we typically see in these markets. So this is just to give you an explanation that different products, different kind of investors have different expectations, and we need to have policies which addresses each of these expectations very clearly. Let's move on. Yeah. Now, what we have, what we have tried to do in terms of in terms of putting this up is that from a market size, sustainability, and return point of view, because we showed you what the investors want, and now we are trying to show you what how the drivers are within each country. So from a market size perspective, we see that countries such as India, Nepal, Bhutan, Pakistan have a fairly reasonable market size to attract big investors. From a sustainability point of view, again, I think barring Afghanistan for other reasons, but other countries are fairly reasonable in terms of sustainability, which means that you have long period contracts available, you have long term vision of inviting investments. So that is quite good. Market returns, project returns, in fact, in many of these countries have been again reasonable. So from a market perspective, from market size, sustainability, and returns, we see that most of these countries have things in place. Now, what this essentially means is that from a purely sectoral policy point of view, so from purely energy sector policy point of view, we have reasonably good policies in most of the countries. Reasonably good policies, which are also changing from time to time, but these are reasonably well placed. The challenge, however, is when we move from sectoral policies to financial market or financial sector policies. And this is where we believe a lot of improvements are required in many of the countries, including likes of Bhutan, even in Nepal, Bangladesh, Sri Lanka. There could be a lot more done in terms of the financial market policies, which can attract larger institutional investors into the country. Can we move on? Yeah, so this is the taxation policies, and this is extremely important, which often is not very it's not too much spoken about, especially in sessions such as ours or presentations. Uh, that a right taxation policy, which basically is transparent and which provides less home taxation, that is less taxation at the home country, is extremely attractive for long-term institutional investors. And this is where I think there is a whole lot of interventions which are required in most of the countries. We need to think of innovative instruments which are more tax optimized. For example, trust-based structures, which in India it's newly introduced and it's becoming famous, but in countries like Singapore, in US, trust-based structure has been there existing for a very long period of time, and they are fantastic vehicles to raise capital for infrastructure projects which have a long gestation period. The second bucket I would say is in form of enablers, and this is what I was talking about. That how do I use public money in the best form possible? Now, if I use public money just to fund a project, uh, 1 million sets up 1 megawatt. But if I use it as a financial enabler in form of providing subsidized letter of credit or guarantees or insurance, because most of these products are not commercially very much available within the SAARC countries. We don't have a very vibrant market which are structured for renewable projects or infra projects rather. So what we have seen is that if we can use public money in providing these kind of financial enablers, it can actually have a multiplier effect of 5 times, 10 times, or 20 times of the money that I'm putting in. So instead of 1 million for 1 megawatt, 1 million, we can actually build up 20 megawatt of assets. And that's the power of multiplier that we can have. And I think the fourth one is that to have some sort of incentive mechanism, and this plays a very dominant role in attracting investments into clean energy, is if we can have certain financial incentives which are provided for clean energy investments. Just to cite an example of India where I've seen this market for fairly long, is that there was huge investments which got attracted to wind sector, predominantly because there was something called an accelerated depreciation given to wind investors, which meant that you could offset the depreciation that you have on your other businesses, and the profit that you're earning from other businesses. So this led to a huge amount of investments in wind energy. Right now, in fact, we have right now accelerated depreciation is not there, but we have other forms of incentive. For example, lower tax rate if you are a pure play renewable companies. And measures such as this is important because this is a sector which anyways is giving you much more societal benefits. And if we go for a slightly lower tax rate or slightly preferential tax rate, actually it is not it does the country doesn't lose out anything. In fact, we still are a net gainer as a whole. And if this can push investments up, then certainly this is something we should look to do. Can we go to the next one? Yeah. Now I think we will go to specific recommendations, and I think this what can be done. And I think we should directly jump to the recommendations for for country levels, for each country level recommendations. I think we have less time. So, for example, in Afghanistan, I think very clearly from a clean energy policy and institutional and regulatory environment perspective, that's the first bucket of interventions. Uh, Basically, what it requires is that you need to set up a very clear strategy, a very clear plan to have a clear policy targets which are there for the hydro, wind, solar energy sector, etc. You need to have schemes which are available on what kind of investments can happen within each of the sectors. That's what the institutional clean energy policies and institutional and regulatory environment is concerned. And in fact, in most of the SAARC countries, this is one of the areas where we are fairly good. We are doing most of the policy work around clean energy fairly well. The second recommendation is alternate means of financing, and this is beyond the debt and equity that we think of. And so one of the very clear recommendations is that can we have a sovereign guarantee or a partial guarantee mechanism so that the credit risk can improve, because many of these utilities that we have are buyers which are doing not so well. And in fact, we have seen that sovereign guarantee and partial guarantee can be extremely helpful in getting low cost, in getting good investors onboarded. One of the best example is Riva Solar Park, which had a very similar guarantee structure. It was able to get substantial investments and at a very low rate. Similarly, so if the government is not keen on giving guarantees which can mean some contingent liability on its book, then at least a letter of support can be can still be to a degree helpful if you are not able to do the first one. And the third one is that have put up some policies for creating a green finance market, and there could be specific incentives which are given for green financing market. And I would like to cite an example. For example, we could have a policy that if banks are funding renewable projects, the tax rate that they pay out on the net interest margin that you get on renewable projects can be at a lower rate. And this can be immensely helpful. It will actually promote banks and other institutional investors to invest more into clean energy projects. And the fourth is looking at trust-based vehicles like InvITs, which are InvITs or business trust in Singapore. Any of these structures are very similar to each other. The idea of these structures is that you create a very tax efficient structure where investors can come invest and stay invested for a very long period of time. So that's the effective reason of such structure, and there are fair examples available across the world that can be looked at. Then the other important aspects within which has to be a very big focus of countries is strengthening our financial institutions, be it forming a dedicated development financial institution like we have seen in Brazil, in Canada, in Japan, and in China. Easing out FDI norms specifically around infrastructure. It should allow very easy entry and exits to global investors. And in certain countries, Islamic financing facility, wherever it can be used, can be also quite helpful. In fact, we have seen examples in Indonesia, Malaysia, where this has been substantially successful in terms of generating interest in infrastructure projects. The fourth bucket of interventions is around capital market. We need to have policies, or we need to create a vibrant, specifically, I would say, debt capital market, because equity, I think most countries are doing it fairly well. The sixth one is, as I was talking about, that we need to provide some incentives to green investors. This will help attract more capital. And on a net-to-net basis, the countries will not be at loss. They would actually gain if we have a lower tax rate and we are able to attract more capital. And I think the last one, which is not talked about much, is we need to understand the reason why clean energy today is affordable is because of technology. Because people have invested, or countries have invested in technology, and that had actually caused a lowering of prices. But from the security of a region perspective, these technologies are basically monopolized by certain different other countries, right? So, and of course, when you have issues such as the global pandemic, where we recently had like COVID-19, it would also have an impact on the entire supply chain, and we really saw that when the lockdown happened in many countries. It had an immense impact on the supply chains that are created. So it's very important that as a region, we invest in creating our regional supply chain. We invest in creating or harvesting our local technology. We have immense, technology capability within the region to make this happen. I think it might lead to short-term discomfort in terms of how do I promote regional the regional capacities or regional products, and I only buy from the region. So it might lead to short-term discomfort, but this is very, very helpful in long run, and this can be immensely beneficial in long run. So certainly we should look at more intra-regional cooperation as far as clean energy is concerned. Can we move on? Yeah, so that's the end of our presentation, and I'm sorry, I think I took more time than expected for the presentation, but I would be very happy to address if you have any questions.
Thank you very much. Thank you, Sandeep. No, you managed it in very good manner. I'm surely that this visionary roadmap will definitely help member states in getting finances for renewable energy projects. Well, we have obviously so many questions, but keeping the time, we will try to cover as many as possible. So our first question is that how do you compare utility scale solar energy projects to rooftop solar projects in terms of their overall impact on energy sector and cost of generation?
Yeah, very good question. Because there has been different experiences that we have seen across the world. For example, we have, and maybe just to give a very closely related examples that people can understand. So Europe has largely led development. Europe, and when I say Europe, specifically countries like Germany, led their renewable energy development through investing more on rooftop projects, whereas country like US, their growth has been more, while they've done rooftop, but their growth has been more around utility scale projects. So effectively, there are, I would say, both are equally important, but there are certain cases when both are useful. For example, if let's say we talk about a country which is very tightly packed, you don't have free land available, then certainly you cannot set up utility scale projects within your country, and you need to rely on rooftop projects. Particularly from a cost of generation perspective, I think uh, rooftops would be slightly, very, very nominally expensive compared to utility scale. Now, expensive predominantly because the utility scale investors are able to negotiate better prices for the equipment than compared to solar, but otherwise, compared to rooftop, because rooftop essentially don't need to buy land, you don't need anything else. You can actually, it's very easy. It can be set up within a month's time, irrespective of the capacity. So there are benefits to rooftop as well, but I think from a cost perspective, at right now, utility scale is slightly lower, but there is use for both. I would say we do need utility scale, large scale projects, but utility scale, large scale projects essentially would also need substantial invest in transmission capacities that needs to be done, and a country should actually look at that. How do they want to plan their renewable development? For example, India has gone for a fairly large utility scale program. And while we have had rooftop development, but it's predominantly utility scale, which is picked up substantially in the country. But what we are seeing in some other countries like Sri Lanka, etc., is that there is a fair bit of vibrant rooftop market which is coming up. which is I think a country needs to plan its own renewable strategy. Both have its usage in certain ways. There are benefits in both, and the prices are not that much different that we should focus on one over the other. The prices, I would say, is very, very nominally different compared to each other. Why the prices may seem a little different, specifically when we go for a solar rooftop, is that the customer cost in a rooftop is much higher. So the cost of acquiring a customer within the region, if I want to do a solar PPA, is extremely higher. It's about 3 to 5% of my project cost. This is comparatively less in case of utility scale project, where the cost of acquiring a utility scale project is not much because you just participate in auction and you win and you sign the PPA. But the cost of acquiring a rooftop customer is very high. So that is the only difference. But otherwise, from project perspective, the cost is not much different.
Thank you. Thank you. Very well explained. So our next question is that since you mentioned that government is enabler and it makes sense, but what sort of enabling environment the government should provide apart from policy instruments? Do you think grants and subsidies could play a role in realizing the utility scale projects in SARC member states?
Well, I mean, so historically we have seen that. So going by precedents, subsidies have played a role in countries like Spain, countries like Germany, in terms of renewable development. So they have played a role. But personally, I'm not a big fan of subsidy. And subsidies made sense when the cost of renewables was 8 cents, 10 cents a kilowatt hour. Today is not so. The cost of renewables is lower than lower than even the conventional power, comparable coal or comparable gas. So I don't think that subsidies is specifically a way. Uh, but the kind of investors we want in renewable sector, they, as I was explaining, that instead of higher return, they're absolutely fine in going for a slightly lower return, but they need lower risk. So government focus should be first in creating a environment which is low risk, which means that the utilities who are buying power do not default, which means that they need to be given adequate guarantees, or it could be partial guarantees, or it could be escrow funds in some manner, so that the default is not happening. That is one. Second, they need to ensure that the regulatory system in the country stays consistent for a very long period. Investors do not like when regulations change every other day, having an impact on their returns. And the third thing that needs to be ensured is contract enforceability. Once a utility, a country, or a consumer signs a contract in the country, we should ensure that that contract remains valid throughout, and nobody comes and opens up the contract under any pretext and tries to renegotiate, which sets an extremely bad precedent. So these are, I think, the three big areas where government can play a prominent role. In some countries like Nepal, Bangladesh, where we have issues around hedging, etc., government can come and put up some hedging instruments, or promote some sort of development of hedging market without committing. So I don't think that government really needs to commit a lot of capital, but they need to do a lot of these reforms in order to make it a successful story for renewables. If you would just excuse me for a minute, I need to just.
So, dear participants, as we are closing our webinar, you still have the chance to send in our questions at any time till we hold this webinar. We will obviously try to address your questions. So, over to you, Sandeep, again. So, Sandeep, we have. Yeah, please carry on.
Yeah. No, so I think that was my that was my point on the earlier question. But anything else?
We try to cover all, but as much as possible. So there is another question, that what risks and challenges do you see in independent auctioneering or competitive bidding of utility scale projects?
Pardon me, sir. I could not understand the first part of your sentence.
It says that what risks and challenges do you see in independent auctioneering or competitive bidding of utility scale projects?
Yeah, so so it's a good question, but as I said, on the utility scale project, I think apart from the larger financial market risks which are there in certain cases, and sovereign risk and the exchange rate risk which is there for global investors, I think the other prominent risk which I was explaining previously is around, you know. High risk buyers. Many of our buyers don't have the right financial health. There is a liability of delays, of defaults happening. Defaults don't happen, but there is certainly, investors perceive it as a big risk, which is why they would be less affinity to invest. Having consistent regulation is extremely important. Many investors that we spoke with in some of the more conservative markets like Australia or UK, they have expressed skepticism in terms of having, while it may not be true, it may not be really founded on sound grounds, but the perception is that that we don't have a very strong institutional certainty in many cases. So that's very important. And fourth is, having our contract having very, very sound ground to stay. So legal enforcement of contract, absolutely 110% very more important. In addition to, I think, these three areas, the other things which we need to focus on in utility scale is that, and these are more operational matters, that the biggest challenge in utility scale project is not developing a project, but it's about land acquisition and getting clearances and evacuation permission. So if we are able to create a structure in which, for example, the park structure is where you have a large park and many investors can come up there and set up their assets there, that's a fairly good structure. So those kind of structures would really help in promoting growth in renewables. But that's definitely one of the operational challenges we need to target. And of course, as I mentioned, that having a vibrant financial market to fund the renewable projects would be extremely helpful. So these, I would say, are the top 5 challenges that we have right now.
Thank you so much. One more question we will take, and then we will close up our session. The question is that, do you think establishing a system of credit guarantees could be viable for providing access to finance for realizing of utility scale solar projects, especially when
100% yes.
especially when we talk about immature technologies such as waste to energy. And another part of the question is that how the credit guarantee model works actually for RE projects.
Right. So I first that yes, extremely useful to have a credit guarantee. Specifically, it's more important for SAARC region, where, as I said, the utilities are not very highly rated, and there are sovereign risks and currency issues which are prevalent. It reduces risk from an investor perspective. Uh, what's what's very important to note is that. I think one of the question was that for immature technologies, I think, look, largely if you see the technology landscape, there is nothing which is immature. All of this is established technologies which are well functioning for now over a decade. Be it solar, be it wind, which are the two largest component of renewable, or hydro, third largest component of renewable. These are extremely matured in terms of technology. Waste to energy, I think there's a misunderstanding generally that waste to energy as a technology, it's not immature, and we have seen waste to energy projects successfully running in the west, in the east as well, in East Asia, specifically Japan, Korea. There are other reasons why waste to energy projects haven't been successful in the SAARC region, and it has more to do with we as users, or basically we as producers of waste, and how do we basically produce and how do we segregate. There are really challenges around that, which has been a problem for us. But i i I don't believe that technology per se evaluation is a big risk today, uh, from that extent. And how do these function? I think there are multiple. So basically, a guarantee product can also be very purely commercial in nature. So there are institutions who provide credit guarantees. The one name which clearly comes to mind is, of course, Guarantco, which is a multilateral agency which provides guarantees, and it operates, in fact, many of the SAARC countries as well. Like I think it has a fairly big office in Bangladesh. Sorry, in Pakistan. It has 2 years back floated first project in Bangladesh. It's been evaluating its first investment in Nepal, and it's been there in India also for fairly some time. So that's one of the institutions which provides commercial rate credit guarantees as well. Then you have likes of multilaterals like ADB, IFC, which or World Bank rather, which have their own guarantee products which are available. At times, even some of the aid agencies, bilateral aid agencies like USAID, also provides guarantees, but it's generally defined with whichever projects USAID is funding, they may actually provide guarantee, although it's slightly tough to get. Uh, and then you also have pure commercial bank, pure financial institutions who can also provide guarantees. Uh, but when we really talk about from government perspective, government can provide guarantees which can be both funded as well as unfunded. So funded guarantees are basically that government will allocate a small pool of capital, let's say 100 million, and then they issue guarantee out of that. And this fund can be independently managed by either central bank or some other financial institution, and the government can issue guarantees out of that fund. In these cases, there is always a limitation of guarantee that is being given, and the limitation of the guarantee should not exceed uh, either 100 million or maybe a little more than that. Also, you can leverage slightly more than that. You should not. So there is a limitation guarantee when you have a funded liability or with your current guarantee. And then you can have an unfunded guarantee, which is a plain letter of support from government saying that if the entity doesn't pay, let's say it's one of the distribution companies in Pakistan. So if that doesn't pay, then the government of Pakistan will pay for that. So that could be the unfunded guarantee, which could be in form of a letter of support, etc. So these are typically the ways in which guarantees can be provided. There are ample sources of it. So I hope this answers the question well.
Yeah. I believe I am very clear about it, and I hope that everybody is clear the way you explained. Thank you very much. Thank you, Mr. Sandeep Kumar, for sharing your knowledge and taking us through the details.
Thank you.
Thank you for excellent response to the queries raised by the participants. Thank you very much.
Thank you.
So, dear
Thank you, sir.
participant, thank you very much, and we are really obliged. So, dear participants, we came across many interesting and useful information through this presentation. I believe many good experiences have been shared and good lessons learned. I would like to pay my deep respect to all the participants for your enthusiasm and positive participation in this video conference. Finally, I would like to thank our own staff for organizing this event and ensuring it ran smoothly. I would like to close my remarks and officially announce the end of the video conference, wishing you all the future prosperity for South Asian nations. Thank you for your attention. May God bless you all. Thank you very much. Bye-bye.